Hello, traders. This is Dave with the Compass Options Room and the Compass Alert Service. Just getting things set up here and ready to go. I need another 10 or 12 minutes to get going. A lot of folks logging in early, so welcome to the webinar. I appreciate you folks coming here on a Saturday to talk about options. And if you can hear me okay, and you can see the screen over here that says Compass Options Room, would you go ahead and put a yes in the question box just so I know that you can hear me and see my screen? Thank you very much. And good afternoon, good day. This is Dave with the Compass Options Room and the Compass Options Alert Service. Listen, if a lot of people logging in here, but I'd like to make sure that my the videos, the audio is working and the screen is visible. So if you can see the screen over here that says Compass Options Room and you can hear my voice, if you put a yes in the question box, I appreciate it. Thanks, Kathy. Appreciate it. A lot of folks logging in. Again, we'll get started here in about 8 or 10 minutes or so. I'm just getting everything set up. I appreciate you coming in on a Saturday, traders. We're going to talk about my Compass Options Room and Alert Service, but we're going to spend quite a bit of time on basic options that we'll try to get into the details that you need to be able to actually trade options successfully. I think I'm not sure if how many folks have traded options before here. I assume quite a few, but we'll get into some detail on options, and I'll keep this question box open so we can talk about those as we go along. We'll also talk about the options room and the alert service. Talk about some of the results we've had. This room has been operating now, the Compass Options Room, for 2.5 years, since January of 2022. And with great success. We have about an 87% win rate over time. So we're going to talk about that. I'm going to talk about the strategies that we use and the methodology that we use. And we're going to go into some details on what options to trade when you take an option trade. So a few more minutes, we'll get started. Again, thanks everybody for coming to the webinar today. I really appreciate it. And we'll get started here in just a few minutes. Good afternoon and good day, everybody. Again, this is Dave with the Compass Options Room in the Compass Alert Service. So we're going to get started here in just a couple of minutes. I'm letting a lot of people logging in, so we're going to let another minute or so, and then we'll get started. We're going to be talking about, I'm going to talk about the Compass Options Room that I have, as well as the Alert Service. We'll go over some of the results, and we're going to spend quite a bit of time on options, basic options information to try to help folks who maybe would like to trade options or trade options, tell you what I think is the critical information to know about them and how to use them. We'll talk about different option strategies for different market conditions. And I think the information is going to be very useful. So again, my name is Dave, and I run the Compass Options Room and the Alert Service. Been doing this for a little over 2.5 years now. Started the room in January of 2022, which, if you remember, was exactly the beginning of the bear market. It's 16 months of a bear market starting in January 2022, and we've been able to maintain about an 87% win rate over that time. Most every month is profitable. I think we've had 3 losing months out of 32 or 31 or 32 months. So we're very consistent. We're very, very methodical. We have a very disciplined methodology we use to trade high probability trade setups. So we'll talk about that as well. So again, good day, everybody. Again, thanks so much for being here. I very much appreciate it. And we'll get started here right now. All right, so this is going to be the basic options training. We're going to talk about the Compass Options Room and the Alert Service. And again, my name is Dave. Just to kind of some graphics here. And I've been trading, professionally trading options for about 14, almost 15 years now, and part-time trading for quite a ways of time before that. So I've been doing this for quite a long time. All right, first thing I have to do is do the usual disclaimer. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. All right, if you have any questions, by the way, that I'm going to try to answer all the questions, but if you have any questions that perhaps I won't be able to answer, or you want some more details on some of the offers, etc., just put your name and your phone number in the chat box or in the question box, or your Skype username, and Rory, who is from Right Line, he'll follow up and give you a call back. I think he's out today, actually, but he'll give you a call back tomorrow or Monday. All right, and I'll put this in at the end again so you'll know. All right, so this is just a graphic of what's called this. I'm going to talk about the SPY super system too, which is basically high probability trading for intraday, very quick intraday trades. We'll talk about that, but this is kind of graphics of what the Compass system that I use that runs on my Thinkorswim platform. Although I do not trade through Thinkorswim, but I load it on Thinkorswim because that's where the Compass system goes. It goes on there and it goes on Ninja. So we'll look at all of the indicators on the Compass system and how we use them in some fairly quite a bit of detail. We're basically tracking institutional money flow. This is what the Compass Alert Service looks like. Basically, the alerts come out on your phone, SMS text alerts, and we'll go over exactly what you get with the text alerts. It's fairly quick. I have it on my phone as well, so I know how quickly the alerts are going out. Usually about 15 or 20 seconds after they're posted, they go out. All right, so the first thing I'm going to cover, and I cover this every webinar, and if you've seen webinars before, you've seen this before, but bear with me a minute. It's very important to understand what moves markets, why markets drive. The most important thing to understand about trading is that you have to use market first. You've got to be watching the market and know what the market's doing, because the market drives most stocks. It's probably 80% of the stocks are going to move with the market. So it's very critical to understand what the market's doing. So what really does move the market? Well, these are just a graphic representation of retail traders. This is us, the retail traders, with the little marbles out front here. And imagine I'm a retail trader, and I imagine most everybody else here is retail traders. It's critical to understand when retail traders are trading and institutions, which is this big marble here, are not trading. What you get is you get a lot of chop and you get a lot of chaos in the market. There is no directional trend or momentum. Retail traders cannot move the market or create momentum. The institutions do that. The institutions are made up of, as you probably know, the big investment banks, Goldman Sachs, Morgan Stanley, JP Morgan, but they're also made up of hedge funds, hundreds and hundreds of hedge funds with billions of dollars to trade, and also mutual funds. T. Rowe Price, Vanguard, all these huge mutual funds have billions of dollars that they're able to put into the market. This is what moves the market. When these folks are buying or selling or driving the market, when there's enough of them doing it together, that's when you get a trend. And our job as traders is to follow what the institutions are doing. We don't care what the retail traders are doing. We're going to take money from other retail traders because we're able to identify what the institutions are doing and take advantage of that. Basically, we ride their coattails. You're never going to be able to make any money from the institutions. We just need to know what the institutions are doing so we can know whether to be in a trade or not. So this is really important to understand. Okay, so we have a couple of rules to trade by in the trading room and on the alert service. Pretty simple ones: trade the best, skip the rest. We don't take just trades that are likely to succeed. We like to take trades that are the most likely to succeed. So it takes us, we have to be very patient. We just look for the best trades, and those are the ones we're going to trade. We're going to skip the rest, and this is really important because skipping a trade that is 50 or 60% chance of being profitable is not a good edge. We want to be in trades that have an 80%, 85% likelihood of being successful. And the other thing I always say in the room is our objective is not to make trades. Our objective is to make money. And sounds kind of obvious, but what happens is a lot of traders, when they have a trading account and they're sitting in front of the machine or on their phone and they want to trade, they feel like since they're a trader, they need to be in trades all the time. So they end up picking a lot of crappy trades because they're not able to maintain the patience that they need to find the best trades. So this is why I say this. Our objective is not to make trades, it's to make money. And we do that by taking the very highest probability trade setups only. Okay, so we need an edge. As a profitable trader, we need to have an edge over other retail traders. This is the edge that we here have in the compass room. Our edges, we have the right blind compass system. This tells us when the institutions are in a trade and when they're not. So this is really critical. We're only going to trade stocks, options on stocks that have institutions in that particular trade. And we also trade what's called relative strength and relative weakness. This is really important. This is not RSI. Relative strength, relative weakness is comparing your stock that you're looking at to the movement of the S&P 500, the SPYs or the triple Qs. We're going to trade stocks that if the SPY is going sideways and down and your stock is going up, then it's got relative strength, and vice versa on relative weakness. The reason this is so critical is if you get into a trade and the market reverses on you, you're not going to get hurt anywhere nearly as bad because your stock is outperforming the SPY. So it'll likely not drop as much, or it may even just continue to go sideways or up a little bit. So these two edges right here, if you trade only when the institutions are in the trade and only trade stocks with relative strength and relative weakness, you're going to have a giant edge over other retail traders. Most other retail traders, 99% of them have no idea what the institutions are doing. And they also don't even know to use relative strength and relative weakness. They're using things like MACDs and Fibonacci's, etc. And this is what gives you the edge. And then we're going to trade with the market trend if there is one. So if we've got a bullish day and the market is trending up, we're going to mainly focus on bullish trades that day. And the fourth thing is we buy near support and sell near resistance. And this is important. This forces you to wait for a trade to come to your level that is a support or resistance level, bounce off of it, and then go back into the original trend. That's when you get into the trade, because it gets you in at a level where your likelihood of a loss is smaller, and the size of the loss would be smaller if it reverses on you. So these are the four critical things we use. Now, the compass system, and I'm going to talk about this, is a piece of software that runs on, I have it running on Thinkorswim. It runs on Ninja as well. And And it identifies the highest probability trade setups while sidestepping setups that look good but will fail more often than they succeed. This is because we'll know when the institutions are in the trade. It identifies, obviously, when institutions are driving the move and when they're not. It analyzes a very complex trading data, but it displays the results in an easily identifiable format. And this is important because, especially for a new trader, if you don't have a lot of experience in technical analysis, it's really hard to know whether you've got a institution that's in the trade or not. And what this does for you is just by looking at color schemes, you can tell whether the institutions are in it or not in it, and whether they're bullish or whether they're bearish. Really, really important. What kind of indicators make up the compass system? I'll get into exactly what they are. There's several of them. We look at mainly four different indicators. We look at current time frame momentum, multi-time frame momentum. We look at the long-term trend, and we look at the derivation of money flow. But we look at them across multiple time frames, and that's what makes this critical. You have to you have to look at all these in conjunction to see if there's institutions trading or not. Okay, and I'll cover that in a little bit more detail here in just a minute. So who are what are our edges here? We take trades that are being driven by institutions. We trade stocks that have relative strength or relative weakness to the SPYs or the Qs, and we trade in the direction of the overall market. That's really important. This gives you a giant edge over other retail traders. Again, our trades will be supported by institutional buying or selling. The stocks will be outperforming the SPY or the Qs, and the stock will be moving in the direction of the overall market. Those are our edges, gives us an edge over other retail traders. Sounds easy. It takes a little bit of work to do this. Okay, for looking for high probability trades, and I just kind of want to go over the methodology that I use in the room and what I use in the alert service to find the very highest probability trades. This is called what I call a funnel, a trade setup funnel. It's just a mental process I go through. When I look at a stock to see if it's something that I want to trade, the first thing I look at is to make sure the daily chart is lined up in the direction I want to trade it. If I'm bullish on the stock, I need to have a daily chart that's bullish. Daily chart needs to be bullish, and then the 5-minute chart needs to align as well. So if I like a trade long and I want to swing trade it, then I've made a determination I'd like to swing trade it. I'm going to wait for the 5-minute chart to align up and give me a bullish setup on the 5-minute chart so that I can get my best entry on it. So those two things are really important. We're going to trade with the trend, the stock on the market trend, if there is one. You may be able to do this, you may not be able to do this. It may be a choppy market. But you're always going to go to the compass indicators and make sure they align. So you're going to go long. I'm only going to trade stocks that have the compass indicators telling me that institutions are moving that trade right now. If it isn't, I'm not going to take it. And then we also, as I mentioned, we trade relative strength and relative weakness. So if you're checking each off as a checkbox, this gives you a stock that's likely to become a prospect for you that you could trade. And then you're going to look to see if it's near support or resistance for trading. And if it is and it drops out the bottom, then it becomes a good prospect. If it hasn't, if it's away from support or resistance, what I do is I just put alerts on the chart and give myself an alert when that stock comes to support or resistance to be able to trade it. All right, so that's the probability trade setup funnel. And this is basically the trade funnel written out. But you see the two key ones here. The stock to be traded should have daily and 5-minute charts aligned. The compass indicators must align for the trade. If you've got these two and then you add relative strength to it, you're going to have a massive advantage over the other retail traders that you're trading against. Really, really huge. A couple of smaller things here. When you're trading off the 5-minute chart, you want to make sure if you're going long that the stock price is above the VWAP to go long. Volume weighted average price, which is a indicator that all the institutions use. And if you're going to go short, it needs below the VWAP. And you'll see this on a lot of the trades I talk about today on the 5-minute chart. I'll show you about that VWAP. It's very critical. Okay, and have patience. This is the thing that I reiterate in the room every single day. Have patience. Don't be jumping into trades too soon. Don't be chasing momentum stocks as you're likely to get trapped at the top of the bottom. So have patience. Now, just to go over quickly the strategies that we do use in the room and on the alert service, we do straight calls and puts. We do a lot of straight calls and puts. I also use debit spreads using weekly options expiration. And if you're a member of my room or my alert service, I have videos on all of these, every single indicator I use, and every single strategy that I follow. We also do time spreads. This is a trade we take over earnings. It's sometimes called the calendar spread. It's a non-directional trade. I don't care which way the stock goes over earnings. I'm just trying to capture the volatility difference from this week and next week. And again, I have a video on that. And then I have what's called the weekly ATM strategy. This is a strategy that basically collects premium each week by selling puts against a neutral to bullish stock and holding a longer term dated put further out in time, 4, 6, 8 weeks out in time, so that we've got protection against a quick turnaround and the stock goes against us. And it also minimizes the amount of margin that we need on the trade. And then we do some basic credit spreads. If you're familiar with credit spreads, it's basically just a way to capture premium by taking advantage of the time decay on the trade. And I have videos on all of these and how they're set up. I'm not going to go into a lot of detail on each one today. And then this one I am going to talk a little bit about today. It's called the SPY super system. And this is what we use for very high probability trades to catch SPY moves or the Q moves. Now this is a particular strategy that I do inside the room. I can't do alerts on these because the trades are much too quickly. But these are intraday trades that we take, and I'm going to talk about these a little bit for folks who, let's say you want to be a room member, but you can only be in for a couple hours, or you come in and out during the day, so you're not going to see all of the trades that we talk about. But if you're in there and you know how to do this SPY super system trade, which I have a video on it, and I go over it every single day, this is a great way to make some money in choppy markets, and when you can't be around a lot. It takes advantage of the indicators that we've got, but we call it the SPY super system because there's specific setups for this. And it's a great strategy. You're only in one trade at a time, and it's a very, very quick trade. A lot of these will only be 2 or 3 candles, maybe 4 candles, and you're out. 5-minute candles and you're out. So if anybody's interested in trading and trading indexes for intraday type trades, fairly quick trades that you can get in and out of, we'll go over the SPY super system. And I've got some results that we used for this. But again, it's not something that long-term trades. This is mostly for folks who want to trade intraday off the 5-minute chart. I don't know if we have any folks here like that. If you are interested in that, let me know. Put a yes in the question box so I can spend more time on it when I get down to it a little bit later. All right, so the alert service. What is the alert service? Well, the alert service is designed for day trades and short-term swing trades. These are not long-term trades. These are going to be intraday, which we're going to typically for an alert, it's going to at least be several hours. Usually we might get in at 10 or 11 o'clock in the morning and get out sometime during the day, 2 or 3 o'clock or something like that. And then we have short-term swing trades. These will be overnight trades or trades that go out as much as 3 weeks. Sometimes I'll be in a trade a couple of weeks, 3 weeks, but generally speaking, most of these trades are not going to be any longer than 2 to 3 to 4 days. And these would be the ones that we obviously alert on, and anything that we alert on is also taken in the room. And it's important to understand that I take these trades, every trade that I alert on, every trade I talk about in the room and post, I take all those in my live account, so I know exactly where they are. I get folks tell me all the time, we're in this trade, we're down a little bit of money on this, and I just tell them, yes, I do. Since I'm in it, I know exactly where we are. And again, this is designed for traders who can't watch the market all day, or maybe don't want to watch the market all day. They just want to get alerted to some high probability trades that is set up and make some money on that each month after month. And we do these real-time alerts only on the highest probability trade setups. So that's important. Some days you won't see any alerts, and maybe 2 days you won't see any alerts. This market right now has been really, we had a big drawback in the market and then a bounce, and it's really tough to take any swing trades right now because there's been a lot of gaps. So we stick to mostly intraday trades, and the number of alerts is going to be low. When we have a really good market, they'll be much higher. And typically you're not going to have on the alert service, you're not going to have any more than 4 or 5 trades on at a time. Some of them would be credit spreads, it's something you don't really have to follow all the time. But for trades that are I have to monitor, probably 4 to 5 would be the max that would be on. I think right now we've only got 1 or 2. Is again, we find the highest probability trades by identifying institutional involvement and by making look at market internals. which is, you know, the number of stocks moving up versus the number of stocks moving down based on volume. And then I do technical analysis on them. So that's what the alert service is like. That's where the information comes from. Now this is an equity curve of the room, what we've done in the room. This assumes that you're putting $2,000 into each trade that we take in the room. So this is what the cumulative performance has been since March 2020, March 23. So about a little over a year. Pretty nice. I mean, this is fairly. The months are relatively consistent. I mean, obviously you're gonna have variations in the profits and stuff, but this gives you an idea of it's bottom left, upper right. That's what you want to see. All right, so we're going to talk about options here. I know folks came to hear about options. We're going to go into options right now and talk about the options. First thing I'm going to show you here. This is what's called an option chain. So this happens to be Bristol Myers that I took a couple months ago, but it doesn't really matter. We're just going to look at what information is on the option chain. So you notice you've got down here in the middle, this says strike price. This is the strike price. When you take an option, you're selecting a particular strike price. And you notice that this is in 50-cent increments, and then it jumps to dollar increments. But this is the strike price. These tabs across the top, these are expiration dates. So you can see when I did this, it was in the March 15th time frame. Right now we're up into August, so we'd be over in here now. But the information is the same. So this is your expiration date. This is the strike price. These are important. And this on the left side of the option chain, these are the calls. This is what the price is for calls. In other words, buying something to go long, you would buy calls. This is the put side. Buying something to go short, you would buy a put. So that would be over here. This is what you would select. Now, in here you've got a couple things. You've got, for example, this right here. You see how it's highlighted in blue. This is basically what's considered at the money. The stock was trading, if you notice, the track was trading at 53.79. So the closest strike to that price is right here. This is an at the money strike price, $54. So this is what the $54 calls. This is the bid price, and this is the ask. They always have a bid and an ask, right? 61 and 66. So it's 61-cent bid, 66-cent ask. This is obviously the wider this is, the more difficult it is. The tighter it is, the easier it is to trade, because you're not going to have to pay too much for it. Typically, what you're going to try to do is get filled somewhere in the midpoint. You'd probably be looking to get this for somewhere around 63, 64 cents. Now, this is a delta that's underneath this bid-ask spread. This is a delta. This 52 is a delta, and we're going to talk about delta. Delta is really important. Delta tells you, and I'll go into more detail on it, but delta tells you how much your option price will move relative to this dollar move in the strike price. So the at the money calls here for 54, as if the stock moves $1, your option is going to move 52 cents. All right, so that's an at the money. Now you notice that as you move down deeper into the what's called in the money, because in the money is going to be anything where the call is the lowest strike than where the stock is trading at. So these are called in the money. You notice that the delta keeps going up the deeper in the money you get, which means the ones that are in the money are going to move much faster than the ones that are at the money. Right? So this is typically what I trade. I'm trading in the money calls or in the money puts, and I'm looking for deltas between about 65 and 75. So this is a 71 delta. This is a 79 delta. So I'd be trading something in the 53 call or the 52.50 calls if I was trading this. Now on the put side, it's the same thing. You can see now. Notice that this has a 52 delta and this has a 48 delta. You notice the 52 and 48 add up to 100. All right, so that's the delta is important, and I will tell you that when you're trading options, you want to stick with in the money options. You want to be trading deltas of around 65 to 70, because if you notice here as we go out of the money, okay, we go to a 55 call. Now, obviously 55 call, the stock hasn't got there yet. It's got to go at $1.20 to even get to there. You notice here now how they're cheap. People like them because they're cheap. You can buy them very cheaply. The problem is, look at this delta. Delta's 29. So this stock has to move in $1.20 just to get to the point where you're even at the money. So all of the premium that's going into this is made up of time decay and volatility, which we'll talk about. But that's why you want to be trading in the money calls and in the money puts. Right, so this is the call side, this is the put side. In this particular graphic, important things is you've got a bid-ask spread. It's important to know what the bid-ask spread is, and a delta. This is important to see what the delta is. Okay. What is the highlighted in orange? There's a couple things. This is the strikes that's highlighted in orange here. This is the strike prices. This is the price that you would be looking to buy or your call or your put at. And this up here is the expiration dates. Notice that it has weekly expiration dates. What's the under delta? Right here. Yeah, this is most likely the last price that the stock went off. This was after hours when I copied this off. So that was the last price that that went off at. In this case, you see you've got a delta of 30. You had it bid 29, bid at ask 30. The last price was 29. All right, so one other thing here now. This is one more slide on this. And you see the same thing. Here's your strike prices. Here's your option expiration dates across the top. You've got all the calls over here, all the puts over here. You've still got your delta here, but I've added another column here. This is called what's called OI and volume. This is open interest and volume. Now this is fairly important. The spread to me, the bid-ask spread is much more important, but this tells you how much open interest there is. Open interest on options means how many contracts were open on that trade at the beginning of the day. Right? So in this particular case, on the $50 calls for Bristol Myers, there was 11,867 contracts that were open when the day started. And we've had 617 calls, contracts added today. Now this 617, which is the volume for the day, is not added into this open interest. This stays the same all day long. The open interest doesn't change until the beginning of the next day or at the end of this day. So this 617 will then be added to whatever open interest is available at the end of the day, however many open contracts there are, because there's going to be some contracts that go away. But this tells you how much liquidity there is in the option. So if you get into Bristol Myers and you're trading this $50 call, you know you're not going to have any trouble getting filled on this. Okay, so that's really important. That if you have a high open interest and a lot of contracts, then you can trade it very easily. All right, so that's what open interest and volatility means. All right, let's see, we got a question here. What's my win percentage? My win percentage this year so far, well, actually over the last 2.5 years, is about 87%. About 87%. I've had 92% months, and I've had 82% months, but typically it's around 85 to 86, 87%. Start a hedge fund. Yeah, the problem with starting a hedge fund is, a lot of the trades I take are not traded. You have to be in a hedge fund. You've got to be trading either stocks, massive amounts of stocks that have a lot of liquidity, or options that have a huge amount of liquidity, which would be like ETFs, etc. I mean, if I'm taking a stock like, even Bristol Myers, but especially stocks that have much lower volatility, much lower open interest in them, I can't really trade them as a hedge fund because you can't, I can't go out and put 100,000 contracts on and not impact the price. So not something I want to do. I'm much happier just doing my own hedge fund. Basically, that's what I look at the alert service and the Compass option room as, just for a small number of people. The trade alert options based trades, are the trade alert options based trades, or are there some covered calls? Covered calls, is that what you're saying? There's going to be spreads and there's going to be straight puts and calls. Straight puts and calls, probably 65% of the trades, maybe, yeah, around 70%. Then the other ones are going to be made up of spreads, debit spreads, credit spreads, time spreads over earnings. That would be the most of them. Okay, so I want to talk about basic option topics. What I'm going to cover, I'm going to cover what options are. so that we understand. And a lot of this may be very basic for everybody, but I want to go over it. Just give me time to do that. What makes up an option premium? That's important to know. What's intrinsic versus extrinsic value? This is really important. You'll see when you're going with an in-the-money call or an in-the-money put, you've got a lot of intrinsic value, and this is important because you want intrinsic value, because that is not going to be impacted by the time decay. We're going to talk about Greeks a little bit. I'm not going to go into every single Greek, but I'm going to talk about some of the Greeks. We're going to talk about strike price and expiration dates, volume and open interest, which we've already shown, and then primary option trades, the primary option trades that I use in the room, and all the option trades that are even available, but I don't use them all. So we're also going to talk about which option strategies you use for a bullish position, which ones for a bearish, which ones for neutral. And then we're going to talk about the trade setups. So this is important because when you look at a stock and you like it bullish and you want to trade options, you've got several different strategies that you can use, and you want to make a determination of which would be the best strategy to apply to that particular trade. All right, so we're going to talk about, again, what are options. If you buy a call or buy a put, you basically, when you're buying that call or buying that put, that gives you the right to buy that stock, or in the case of a put, to sell that stock at whatever your strike price is. It gives you the right to do it. You don't have to do it. You can do it if you want to. And this is kind of important because very few people are going to do what's called an exercise. If you buy a call of Microsoft at 100 and the stock is going for 110, yeah, you can go ahead and exercise your calls, buy at 100 and then sell the stock at 110. But most people just will sell the call because it's have gone up a lot in value by then. So that's, you don't actually generally do that. Now the thing here is to understand when you're selling a call or selling a put, that actually obligates you to buy that stock or sell that stock at the strike price if the person who bought it from you exercises their option. So when you're selling a put or selling a call, you're under an obligation. So you have to, you basically have to take that stock if they decide they want to do that. So that's what an assignment means. So if you're in a trade and you get assigned, it's because you've got a short call or a short put, and somebody who bought that call from you decided that they want to exercise it, and they're going to force you to go ahead and buy the stock or sell the stock. So that's important to know. There is rights and obligations that come with them. It doesn't come into play very often, but it's very important to be aware of what those options are. Obviously, you can buy or sell. Say when you're buying, you're along a call or a put. So you're buying a call or a put. That's a buy. If you're buying a call, obviously well, we'll go into that in a second here. And when you sell, you're selling it. You're short a call or short a put, right? So that's, you can buy and sell as well. And this, when you do a spread, you're doing typically buying one and selling another. When you buy a call, it's called a long call. It's a bullish trade. When you sell a call, in other words, you're short a call, that's a bearish trade. When you're buying a put and you're bullish, I'm sorry, bearish, and when you sell a put, you're bullish. So this is the scenario that you're looking for. Buy a call if you like a stock long, buy a put if you like a stock short. These are the two main things that you're going to be doing. All right. So buy a call long, buy a put is bearish. All right, so what makes up an option premium price? Now we talked about on the Bristol-Myers option chain what the cost was. Well, this is what makes up the option premium price. First of all, the options can be at the money, which is if you've got Microsoft is trading at 100, the $100 call, the $100 put is considered at the money. Then you have in the money. So if you have a Microsoft that is at 100, a $95 call, anything below 100 will be an in the money call. Anything above the money will be out of the money call. And this is where you want to put your emphasis when you're trying to buy puts or calls. You want them to be in the money. So that's really important. Too many people trade options by buying the cheapest ones they can find that are way out of the money because they think that they're going to turn $25 contract into a $1,000 contract if the stock goes to this level. But it doesn't work because most of the time it doesn't. You lose, your loss rate on those things is going to be astronomical. All right, so the stock, what makes up the option premium price? Well, there's 4 things make up the option premium price. Obviously, the stock price. Whatever the stock price is at, that's going to be reflected in the option price. Then you have what's called intrinsic value, and we'll talk about that in just a second. The intrinsic value is part of the option price. And then you have what's called implied volatility and time decay. These are the 2 things that change over time. And now implied volatility is exactly what it says it is. It's how volatile is that stock? How much does that stock move up and down in any particular time frame? So if the stock moves a lot, then they're going to add premium to the option price. The option price is going to be more expensive because of the fact that your volatility is high. The market makers don't know how much it's going to go, so they jack up the price of the options. The other thing that comes into this is probably the most important. It's time decay. So the option price is going to drop in value based on how much time there is between the date now and expiration. So if you buy this Monday, you buy a call that expires next Friday. As the week goes by, the time decay is going to be very fast. And time decay starts slow and then it accelerates as you get closer to the expiration date. So if you're out 3 weeks in time decay is going to be pretty slow. If you get 3 days to expiration, it can be extremely fast. And this is what really kills a lot of people if they don't understand how this works. All right. How about liquidity, volume, and open interest? Well, liquidity, volume, and open interest have nothing to do with the option strike price. If you're looking the strike price, in other words, if there's a lot of buying going on, for example, a lot of volume coming in, it's going to impact the option price, but it's going to do that because it changes the implied volatility. And that's what causes the option price to go up when there's a lot of volume coming in. The implied volatility is being pushed up, and that gets added to the premium on the option. Right. So those are the things that make it up. All right. So that's kind of important. So let's talk about intrinsic versus extrinsic value here. So I've got an example. Intrinsic value in option is the in the money value. So if you have a $50 option, if you buy a $50 call on a stock that's trading at 55, then the option has an intrinsic value of $5. Because obviously, if you've got a $50 option, you can turn around and exercise it right then, and you can sell the stock at $55. So you've got $5 of value, of premium value built into that. That's called intrinsic value. So how much of in the money that option is what the intrinsic value is on the option. And the more intrinsic value you got, the better off you are, because you're going to have less of the option price is going to be impacted by time decay and volatility. All right. Now, the extrinsic value, obviously, is the option value minus the intrinsic value. So if I have a $50 option on a stock that's trading at $55, then if that premium is going for, let's say the option premium is going for $6, all right, the $6, the difference between the $5, that is intrinsic value, and the option price, which is $6, that's called the extrinsic value. And the extrinsic value is the value of an option that is going to be most impacted by volatility and time decay, because extrinsic value doesn't have any intrinsic value. Obviously, that's just premium that's on the option that the market makers have built in there to protect themselves. And that's why this is the thing that gets hit really hard by time decay and even volatility. The extrinsic value gets hit really hard, which is why you want to have as much intrinsic value in the option as you can, which is why I take 65, 70, 75 deltas, because I've got a lot of intrinsic value and less extrinsic value. And again, also important is the volume of options traded at the strike price and expiration date, as well as the open interest. We talked about that. That just gives you indication that you've got liquidity to get in and out of the trade if you want to. Okay, I'm going to cover the Greeks, I'm not going to cover every Greek, but I'm going to cover 3 things here: the delta, the theta, and the gamma. Now, we talked about the delta, but specifically what the delta is: how much an option price moves in relation to the stock price move. Stock moves $1, delta of 50 means the option is going to go up 50 cents. Now, as the option price, as the stock price goes up, and let's say you started with a 50 delta, if the stock price goes up, the delta is going to go higher. So the more the stock goes up, the more your delta is going up higher, which means the faster that option is going to move to the upside based on this, how much the stock price moves. So if the stock price moves $1 when you've got a 50 option, and then you make the option price is going to move $1. But now if the stock is up another $1, that your delta may be 53. So the next time it moves $1, you're going to get $53 instead of $50. So that the delta moves up with the stock price as the stock price goes higher. Deeper into the money, obviously, is going to have a higher delta. Now, theta is important. This is time decay. This is a decrease in value of the option price as the expiration date approaches. So theta is going to be really, really important when you're going in a short dated options. You're taking options that expire this week. You're going to have to get that stock to move pretty quickly, because if you're in on a Monday and the stock is trading at the same price on Wednesday, your option price is going to go down by a lot because you've had time decay. Instead of 5 days to expiration, you got 2 days to expiration. So that's going to reduce the value of the option. So that's really important to understand. Now, if you're out 3 or 4 weeks, then it's not going to decay as fast. So even if I take a day trade, if I'm taking a trade that I expect to be only in for today, and I'm going to buy call options on it for, say, I'm going to go long today, and I expect maybe to be out today, I'm still going to go out 2 or 3 weeks as my expiration date, because if the stock starts to go sideways and move against me, I don't want a lot of that option premium getting bled off by the time decay. All right, so it's the further out in time you go, the less time decay you're going to be subject to. But of course, you're paying more for the option because there's more time built into the premium. So, but that's really important. Now, gamma is the rate of change in delta. All right, so I think that the easiest way for me to explain this, I guess, if you've ever seen a stock that you look at it at the open in the morning and it starts shooting up really quickly, you know, it goes up 30% in a half an hour. So everybody's trying to get in on this thing. So what you've got here is you got volatility that's going crazy. But as the stock moves up, let's say a stock goes from $20 to $30 in the first half an hour. What happens is the delta is getting pushed up faster than it normally would, because the stock's moving way faster than it normally would. That's called the gamma. So you might have a stock that you get into that had a delta of 60, and the stock shoots up 10%. Your delta now, which should normally be about 65 or 70, might go to 90. And sometimes you can even send the delta over 100. It can actually have the stock price, the auction price, moving up faster than the stock price is, because there's so much volatility in there. So when you get high gamma, that's why option prices move up so quickly when a stock is rocketing up. Now, the important thing to understand here is, once that stock levels off, let's say you get a stock at 60 and it goes to 70, and you've got a $60 call, and it's maybe $11 when it gets up to 60 now. And then the stock starts to move sideways. All right, it starts to move sideways. The gamma is now dropping. It's knocking the delta down. Even though the stock is going sideways and not coming down, your option premium is going to start to drop. You're actually going to start, that option premium is going to become worth less and less as the stock goes sideways, because the gamma is pulling the delta down. All right, so this is important when you're chasing a stock that's moving really fast to the upside and downside. It can really be a big profit for you. I mean, because you can see these big moves. The problem is, if you don't get out before the move slows down, before the momentum stops, it's going to start draining premium out of there really, really quickly. So that's what gamma is, and that's kind of an extreme example to explain that. But again, the gamma is going to be the rate of change in the delta. As I said, as the stock moves from an existing price to a higher price, the delta can move from 50 to 55 to 60 to 65 to 70, and gamma tells you how much that delta is changing with those options. Right, so those are the Greeks that I focus on. All right, so the primary option strategies that are available, and I'll tell you the ones we use: long puts and calls. Obviously, these are the most common thing. A put credit spread or a call credit spread. This is where you collect premium by going out in time and basically collecting what you're doing is you're actually collecting time decay. You're actually collecting time decay when you do a credit spread. And then a put debit spread or a call debit spread, this basically gives you the ability to get into a trade cheaper than if you were buying straight long calls or long puts, but it also captures profit when you have a debit spread on. And then calendar spreads, which are time spreads. That's the type of calendar spread. This is what I use over earnings. This is a non-directional trade that we have really good success rate with, and I'll show you some of those in our results. And then there's things called condors, iron condors. I don't use these. They can condors typically you're looking for a stock to stay in a range. There's a butterflies, which a normal butterfly is you're looking for a stock to get to a specific strike price by the end of the expiration date, and you create a butterfly. Do that. I do some of these. And then strangles and straddles, which I do. Strangles and straddles are looking for a big move in the stock price. Either way, you don't care. Strangles and straddles, you're just looking for a big move up, a big move down, and that's how you benefit. That's where you get profitability. So those are the primary option strategies. The one in the rooms you're going to see most of the time are calls and puts. You'll see credit and debit spreads, and we do these a lot. I don't usually send out butterflies on alerts. And I haven't been doing strangles and straddles on alerts. I do them inside the room because they can be a little bit more speculative. All right, so those are the strategies that we use in the room. All right. So let's take a look at what, if you like a stock long or you like a stock short, let's take a look at what strategies you can use. Here's a question. Gamma is like metal to the pedal to the metal. Yeah, exactly. That's exactly what it is. And what do I think is the most consistent profit strategy? Well, you know, there's always there's trade-offs in every strategy you take. If you're good at doing credit spreads, that can have a really high win rate, about 90%, a little over 90%. But your gain on those things is typically going to only be about 25%, 20% or so. I think the most consistent strategies, I mean, most of mine, I don't take a strategy if it doesn't have an 85% win rate. If I haven't tested that and have an 85% win rate on live trades, then I don't use it. And I certainly don't teach it. But most of them, all of them have 85. Time spreads have been very good. The straight calls and puts are much more difficult when you're swing trading. It depends on the market. I would say this, for the most profitable strategies, you've got to take a look at the market conditions first. The market conditions are going to determine which strategy is likely to be the most profitable in that market, with that market setup. If a market setup is trending bullish, market's just moving up day after day, then long calls are going to make you the most money. If it's chopping around, then you've got to go with some sort of spreads or just intraday, quick intraday trades. Do I do naked trades? I never do naked. I don't suggest making naked puts unless you want to own a stock at a cheaper price. All right. So, and naked calls to me is absolutely should never ever be done. If you take it, if you sell it, what a naked call means is you're selling a call at, let's say you've got Microsoft at 100. So you sell a call at 110 because you don't think Microsoft's going to get up that high. So you're not going to get assigned the stock. What happens is you're collecting premium because you don't think it goes to 110. The problem here is when you do a naked call, a naked put is just as well, but a naked call, you don't have a defined risk on how much you can lose on the trade. There is no defined risk on the trade. If Microsoft is at 100, you sell a $110 call, and Microsoft all of a sudden is amazingly gets bought out, and the stock goes to $300 the next day. You're on the hook for the difference between the 110 and 300. All right, that is how much you're down on that stock. So you do not have a defined risk with naked puts and naked calls. Every trade I take and every trade I alert on, they have what's called defined risk. You can never lose more money than you put into the trade in the first place. All right. Yeah, Mike points out only certain levels can trade naked calls, cash secured puts. Yeah, again, you have to have in your trading platform, you have to have you're assigned a level as to what they'll allow you to trade. So you know you have to have a level just to be able to trade options. and then you have to have the level to be able to trade any kind of spreads. And if to sell calls or sell puts, you've got to be at the highest level. And again, just follow this advice. Don't sell calls. Don't sell naked calls. Just stay away from that. Okay. So here's the strategies. If you got a bullish setup you like, you're going to either do long calls, obviously. You're going to do short puts, which again, I said I don't recommend. But if you want to own the stock cheaper, that's what people do. You obviously have to be willing to take ownership of the stock. And again, you have an unlimited risk. Put credit spreads and call debit spreads. These are the bullish options that you can choose from. Okay, on a bullish stock. For a bearish stock, a bearish setup that you want, you can sell calls. Again, not recommended. Long puts, which is the most likely thing that you're going to do. Call credit spreads or put debit spreads. You can do either one of these. And again, the market and the price of the options, all of that is going to go into making a determination of which is the best thing to take. Because when I'm setting out a trade in the room or I'm sending out an alert, I'm sending out the particular strategy to take based on my best interpretation of all the criteria for that particular trade and picking what I think is the best one. And these are the neutral option strategies here. Condors, which I don't use. Straddles, again, straddles and strangles. When you do a straddle, you basically, let's say Microsoft's trading at 100. You're buying a $101 call and a $99 put, and it's called straddling the price. All you care about is that stock needs to move up a lot or down a lot. You don't care which direction. Same thing goes for strangles. That's the straddle actually is a $100 put, $100 call, and a strangle it would be a $101 call and a $99 put. Just two different methods to do the exact same thing. And then time spreads or calendar spreads. These are neutral option strategies. They're not dependent on the stock moving, but they benefit by only certain criteria. Condors only benefit if the stock stays in a tight range, in a fairly tight range. Straddles and strangles, you're looking for the stock to move a lot. And time spreads, you're looking for the stock to move over earnings less than what the expected move was going to be, so that you can take advantage of the volatility crush. Okay. All right, so here's the setups that I use for any kind of option setups that we do here. For a put credit spread, what you do is you sell a put, and then you buy a put a lower strike price. You created a spread, and you receive a credit. And there's some really specific criteria that I have to do this. When I sell a put, that put needs to be unlikely to be actually, the stock price is unlikely to come down to that strike price that I'm selling. In other words, I want to have plenty of support above that level. And then I buy a put at a lower strike price. This gives me limits my loss to the difference between the two strikes minus what I paid for what I collected on the credit spread. I'm not going to go into all that detail, but that you can receive a credit on that. A call credit spread is the same thing, except it's, as I said before, this is a bearish strategy, and you receive a credit. A put debit spread, you buy a put and then sell a put at a lower strike price for a debit. All right, so you're looking for the strike, you're looking for the stock to go down, but you're limiting how much you're putting into the trade by actually selling a lower strike price on the put. So you've actually collected some money and paid some money, but it is done for a debit. And then a call debit spread is exactly the same for the call. I'm buying a call and selling a call at a higher strike price, and it's costing me money, but I'm expecting to make more than what I paid for it if the stock moves up in that direction. All right, so those are the option strategy setups. Calendar spreads, which is you sell a put or a call at a near expiration date. All right, like selling this week's put or call this Friday, and then buying a call or put with a later expiration date. And this is what I do on earnings, on time spreads. It's a specific calendar spread. I use a current week's expirations and next week's expirations. So if I've got something coming up on earnings on Tuesday, either Monday night or Tuesday morning, I'll sell a call that expires this Friday, and I'll buy a call that expires the next Friday using the same exact strike price. And that's because this week's call It's going to have much higher volatility built into it because earnings are coming the next week, and that's called the volatility, and it's called volatility crush. When the earnings come out, the market makers now know which way the stock's going to go, and they know about how much it's going to move. They drain the premium out of there, and this is how we take advantage of that, by collecting the difference in the volatility. Again, a strangle, buy a call and buy a put, one strike or more away from the money, and a straddle, buy a call and buy a put, the same strike and expiration date. All right, so those are the option strategy setups that I use. Now, choosing the best, and I've talked a little bit about this before. The strike price, you want the delta. You want to take the strike price. It has a delta of about 65 to 70 to 75. So you look at your delta, and you want to take it in the money. So, you know, if I'm buying $100, if I have Microsoft trading at 100, I'm going to buy a $95 or $96 call on that. It's going to have a delta of around 70. The expiration date is really important. I only take expiration dates this week when I'm doing spreads. But for any straight call or straight put that I take out in time, I'm typically going to go out, 3 weeks, and sometimes further than that. And one other little iteration about this is, if the expiration date that you take is after earnings, and let's say you take an expiration date for 3 weeks from Friday, and the expiration date comes prior to that, the day before, maybe the Thursday before, the premiums are going to be much higher because the volatility for earnings is built into that option. But it's important to understand that you're not going to get as much time decay in that option, because that extra value that you're paying for that option, because it expires after earnings, is going to stay in that trade. So it's not going to, if it goes against you, it's not going to go against you as much. So you're paying more for it, but you're going to get much less time decay. So it's kind of a trade-off. And again, delta, 65 to 75 delta is the sweet spot as far as trading these things. How do I determine the strike price when doing time spreads? Steve, time spreads, when I do a time spread, I'm always doing the call that I'm buying and call that I'm selling this week, and next week's call that I'm buying at the money. I take them at the money, because with a time spread, what I'm looking for is the stock to move, the price to move less than what the market makers are expecting it to move. And if I know a stock doesn't move more than what the market makers expected to move, if I know it only does that, if it doesn't move more than that, maybe 10, 15% of the time, most of the time it falls inside of that range, then I'm just looking for that based on the at the money strike price. So that's what I use. Always use at the money strike price on the time spreads. All right, so that kind of wraps up options. I hope you found it helpful. Again, they're a little complicated. A lot of people think trading options are the same as trading stock. Is not. Yes, you'll get the recording for this done, so that way you can kind of review this stuff. All right, so that's the kind of the long and short of options. I've tried to cover what I think is the basic information to be able to trade. You can do a lot with options. There's a lot of strategies. You're going to hear about all kinds of crazy setups that people use. Broken butterflies, and there's just a million of those things. Try to stick with the basic stuff. I'll tell you, if you're trying to make a trade on a strategy that you don't understand, don't do it. Make sure you understand the strategy that you're trying to trade. It's really important. Again, that's why I have videos in my room. I have videos in every single strategy that we follow in a lot of detail, so you can become knowledgeable on it. All right, so I'm going to kind of review real quickly what our trades were in the room. It's just starting with January, just kind of go through a few months, and a couple of things I'm going to show you here. I want to show you some of the strategies we used. I'm going to show you what our percentage gain was on each trade that we take, because I want everyone to understand that my service, unlike other people, some people will promise you, 500, 600, 700% a trade. It's bogus. That you can't not be consistently profitable with doing that. You've got to be very consistent. And this, you're going to see here that our profitability on any particular trade is going to run from 5% to up to 50 or 60%. We had 65% here in Mara, 96. This was a high one in Boeing, and we have losses. Remember this: everybody has losses. We have losses. This particular month in January, this was January 2024, we had 20 wins and 2 losses, 90% win rate. If you invested $2,000 in each one of these trades, you netted $7,505 profit. You know, and this is assuming 2,000. I just have to have a baseline that I use. I mean, most people don't put the same amount of money into every trade. I vary how much money I put into trade based on what I think the probability is based on what the market's doing. Choppy markets, I'm not going to put as much into a trade. Trending markets, I'll put more into a trade. All right, so but that was January. This was our February trades, and I broke out the alerted trades in February too. We had 24 wins and 2 losses in the room for 92% win rate. This was a really nice month for us. $11,745 for $2,000 invested in each trade. The alerted trades, 20 wins and 2 losses. So you see there's fewer trades that are alerted than we take in the room, because I can take trades in the room that I can't take on the alert service. I can't do strangles and straddles, and I can't post trades that are going to be fairly quick. If it's going to be in it for an hour or less, I try not to post it, because it's not fair to the folks in the alert service. But again, you can see the percentages here. Again, we had some losses here, but you can see the percentages. Stick around the same thing, you know, 20, 30, 40%. And we did time spreads, we did credit spreads, we did debit spreads, we did strangles, lots and lots of different strategies. Just depend on what was the best strategy for us to take on that particular trade. Just to kind of a wrap up here, I'm going to go into the other months, but I did a wrap up of 2023 using 2,000 per trade. If you took 2,000 a trade in the room, it produced a profit of a little over 60,000. So if you had a $50,000 account, just an arbitrary, you would be using 4% of your account balance in each trade that you took at the beginning of the year, and at the end of the year, it would have been down to 2% of your account balance, because the balance grew from 50,000 to 110,000 at the end of the year. All right, so that just kind of shows you what the results were in 2023. The first quarter of 2024, this is the trading room here, 65 wins, 11 losses, 86% win rate, 18.7 for profits. In the alert service for the first quarter, 41 wins, 6 losses, 87% win rate, 12.2. So you can, you can see that the win rate sticks in there pretty good. Second quarter, this was April, May, June, 65 wins, 14 losses, 83% win rate, a little bit lower, but still nice profits, 14,842. Alert service, 35 and 6. We had quite a few less trades in the alert service just because of the market conditions. We had a lot of intraday trades that were really quick. 35 wins, 6 losses, 85% win rate, 11.7 on the profit. So that was the second quarter through June. All right. This is May. I did put in the last couple of months now. I try to get these up as quick as I can, but this was May. 15 wins, 2 losses on the alerted trades, 88% win rate, made 49.79. The room, 29 wins, 7 losses, 81% win rate. This is probably pretty much the lowest win rate I've had for a while. 57, but still 57.36 profit. I mean, this is what matters. You know how much money you're making. And I highlighted the time spreads here. These are the time spreads over earnings. You can see we had a full loss here, but 71%, 50%, 30, 40. Time spreads typically are a little bit more profitable than the straight puts and calls, generally speaking, at least when the market is fairly choppy. This was June. This was a Lulu time spread. There wasn't a lot of time spreads in June because earnings season was pretty much over. But we did 23% here. We had some losses here. We had 25 wins, 4 losses in the room, 86% win rate, 75.90. The alert trades is really interesting. We had 14 wins and 1 loss, 92% win rate, and we actually netted more on the investment on the alert service than we did in the room because we had some other losses in here. But but still, 75.90, 83.16. I think that for the bang for your bucks here is either one of these, the room or the alert service, are really, really good. Can you use your own trading platform to execute these trades? Absolutely. The Compass system is, and I'll show you this in a minute. The Compass system runs on Thinkorswim and for me, and it also runs on Ninja. But I don't trade on Thinkorswim or Ninja. I trade on Tradier using a TradeBot as my front end because I pay a flat fee of $10 a month and no commissions. So I use Tradia. So, but I use the compass system on Thinkorswim to look at the indicators and come up with the trades and stocks I want to trade. So you can trade it on any platform that you want. You can trade off of that. Okay. Let's see, anything else? All right. So that was July. Well, this is July here. Yeah, July we had alerted trades. We had some losses here. 12 wins, 4 losses. Only a 75% win rate. Not a lot of trades. Still netted 33.72, but it was a little bit weak in here. But the options room was 22 and 4, 85% win. Netted 6028 on July. All right. So again, we had some time spreads here. You can see the earnings season has started again. So we had 41% here, 50%. You see the time spreads typically do pretty well as far as that is concerned. Yes, but again, you see in 15, 20, 30, 40% time after time after time on these trades. And this is the August. I just updated this last night. In the room, 6 wins, 1 loss, 2,300 we've made in the first 6 days, I guess. And the alerted trades, 4 wins, 0 losses, up 24.52. So we're getting started. Again, it's not that many trades. We had this Akamai time spread yesterday, 42%. We did Square for 20%, and we had VST on the 7th for 35%. So this is the August trade so far. We're just getting started in August. So the alert service, again, what you're going to get if you get the alert service. So it is a specific profit percentage. Well, I'm not looking for any specific profit percentage. What I'm looking for is I'm looking to I get in based on technicals and I get out based on technicals. So I take the trade at what I think is the best level, and I take profits based on what I think is the proper place to take profits based on the market. Some of them we have higher win rate. You know, when you're getting 60, 70% is typically because the market's trending, so I can stay in the trade longer. If I'm in a trade and it's chopping all over the place, I'm going to probably cut the profits so that I don't stay in as long, because I want to cut my risk and pocket the money. So this is what's going to happen when you're in the alert service. You're going to get the alert with the stock symbol, the option strike price, or prices. I mean, if I'm doing a spread, you're going to get option strike prices, the expiration date, and how much to pay for the option. And it might say, you know, $1 to $1.05 or something like that. So typically I send out an alert when we enter the trade, and then I send out another alert to give you a heads up on what to set your profit target at. In other words, what your sell price should be. And once I give you a sell price, when you get the alert for a sell price, you should mark that trade as good till canceled. Make sure it's good till canceled in your platform. So if you're not in the market in the morning, you can get filled right on the open. This is especially true for time spreads, because we make most of our money on time spreads right on the market open. After the earnings comes out, you've got a big wide spread on the options, and you can pick up some good money right at the open. So now we're going to talk about how I achieved these results. And I know this is getting pretty long, but I wanted to spend some quality time on the options. We were able to identify when institutions are driving a trading, when the market internals are heavily bullish or bearish. This is where we take those trades. And when the market internals are neutral, we'll still take trades if the institutions are in the trade. All right. So again, this is where we get trade the best and skip the rest. And how does it identify when the institutions are creating a trend? We do what's called triple screen assessment. This question was asked early on that we look at momentum, trend, and money flow. I look at momentum across multiple time frames, trend across multiple time frames, and money flow. And this is a derivative of money flow. If you've got momentum moving in the same direction on 3 different time frames, and trend moving in the same direction in 3 different time frames, the likelihood that move is being driven by institutions is about 98%. It's very unlikely that retail traders are going to be able to create momentum over multiple time frames and trend over multiple time frames. All right, so this is just a kind of a quick look at the compass system. This is a trade on Tesla. This is the compass system using what I call Heikenarch reversals, but don't really pay any attention to that. That's a candle structure setup, and I use this when I'm going over the Heikenarch setups. But this, as you can see, what we've got is the key indicators here. This is long-term trend. This is multi-time frame momentum. This is current time frame momentum, and this is a derivation of money flow. These are the critical ones. multi-time frame momentum and current time frame momentum. I'm going to show you in a minute how we use those to find trades and stay in trades. All right. Now I want to talk about this. Is there anybody here that's interested in learning how we do intraday trades off of the SPYs, the Qs, and the IWM, the indexes that we're only going to trade for short periods of time? You know, 2, 3, 4, 5 candles like that. You are okay, Zy Jones. Okay, now this is what I use now. I can't alert on these, but this is what we do in the room. And I've been doing this for a while, but I haven't really focused a lot on it because most of the stuff that I was trading was, you know, swing type trades and overnight trades and things like that. But if you can only come in, let's say you're in the room, but you can only be in there for, you know, a couple hours during the day off and on, then what we're going to do is we want to have an ability to make some trades that we can get in and out of quickly. We don't have to watch them all the times, and we can take the trades and then be gone, and then come back a couple hours later and take another trade and then be gone. So this is called the SPY super system, and it applies to SPYs, Qs, and IWM. Now this is what I started tracking these in July. I've been doing them for a long time, but yeah, these are 0 DTE trades, Gopal. Yeah, the only time they're not 0 DTE is if I decide to take a SPY super system trade at 3 o'clock in the afternoon. I'll take the next day's options expiration, but I'm not going to stay in overnight. But I don't want to have time decay dragging that premium down too much. So I'll take the trade at 3 o'clock and I'll use the previous days. But that's the only caveat to that. Generally speaking, they're all going to be trade expiring today. Yeah. So. For what I did here, and I'll show you some of these setups. In July, for the super system, I had 2,000 invested in each trade, produced 25.96. Not a lot, but it was 16 and 0. And again, some of these are fairly quick trades. August, and I've started doing more of these because we've been talking about it in the room a lot more now. Was 19 and 2, produced 3,600 so far this month, and it's only the 10th of August. So this is up through the 9th of August, 19 and 2. So that's a pretty good. And I trade the SPYs, the Qs, and IWM, but I trade the strongest one or the weakest one. If I'm going strong, if I'm going long, I'm going to take whichever index is up the most for that day, as long as it's not close to a resistance level. All right. And again, with the SPY super system, you're only going to have one trade on at a time. That's all you have to manage, and they're going to be very short duration. You don't have to worry about staying in the trade for 2 hours. It's not going to happen. And typically, these kind of stock trades are going to be fairly quick. All right, so I'm going to show you. This is one that we took yesterday. This is one that showed up on yesterday. Now, this was on the SPY. This is the SPY right here. This is the compass system. This is a 5-minute chart. Here's some key things here. Now, what I'm looking for is specifically, I'm looking for the current time frame momentum right here. Red is bearish, yellow is bearish, blue and green are bullish. Right, so I'm looking for, ideally, a switch from institutions selling to institutions buying, right? And that's what that did right there. And I'm looking at this 5-minute chart. This pink line right here is the volume weighted average price. That's the VWAP, all right? And somebody's asking, what strategy am I using for intraday? I'm going to show you right now. I'm looking for a stock. The SPY was up, so I'm going to trade it long. It was the strongest. It was the strongest index with the furthest away resistance level. So I wanted to buy it when it went from red to blue, which it did right here. It was breaking through this volume weighted average price. See how it's coming up through the VWAP? It's now above the VWAP. That's a institution's buying. Here's the current time frame momentum going from sell to buy. So this is where I bought it, and it's staying above the VWAP. Now I just stay in this thing. These are pop out of the box symbols. These are telling me that the price is breaking compression. Right, so that's why I'm taking these prices breaking compression, and this is where the stock went to. Now, once I start to see some hesitation or momentum being lost, if I'm up enough, I'll go ahead and take it off. And this was good for about 220 per contract on the SPY. And I think the calls were going for about $1.90 or something like that. But that was a pretty nice move. So this is the specific strategy I'm looking for. Now, the color change is important, but it isn't critical. because if it's already bullish, maybe I didn't actually get the color change here, but the stock price stayed below the VWAP. Once it breaks above the VWAP, as long as it's blue or green, then I would be able to get in and I can take it. Now this other little thin green line here is what's called the 15 EMA. The whole thing is clear as mud. David, yeah, I understand it's confusing. But you got to remember that there's a lot of stuff on here, but all I'm really looking for is the current time frame momentum to be bullish and the stock to be breaking above what's considered a resistance level, which is VWAP. And again, this isn't for everybody, okay? I understand. Am I using calls or debit spreads? I'm not using any spreads on these. I'm using straight calls and straight puts. Right here, I bought SPY calls. I sold the SPY, I got rid of them here. That's the setup I'm looking for. And I can understand that it seems confusing, but the reason I'm talking about this is I've had a lot of inquiries from folks who want to be able to trade intraday with a strategy that is, that they can structure themselves. If you've got the compass system, you can see this. It's clear as day. As a lot of times you're not going to have the setup. There's not going to be any setup you're going to want to take. But all you're looking for is a bullish stock in it for a long, the current time frame momentum being bullish, the stock breaking above a resistance level, like such as the 15 of the VWAP, and then you buy it. All right. David, you said you're totally lost. Do you have any specific questions? And more discouraged than ever. Yeah, I understand. Like I said, this is specifically designed for people who understand some trading. If you're not, then what you're looking for is the information I talked about before, which is the alert service, and in the room where we talk about, we go into a lot of detail on the setup criteria that we use. The strike price on the SPY, Paul, I'm usually taking right at the money calls or at the money puts. Most trades put on within the first hour or later in the day. Mostly, I don't take too many trades until at least a half an hour has gone by. It's really too difficult to determine what the market direction is going to be in the first 15 or 20 minutes. A lot of times you end up chasing that. I mean, I have people in the room that do that. They'll take a call right out of the gate because you're getting in and out of them fairly quickly. But I usually wait for the first half an hour or so. And again, I do use that. I use in the money calls or right at the money calls for that particular trade. So that is a SPY super system for anybody who understands it. And David, I understand that this is very confusing. If you look at I have, like I say, I have videos on all of the indicators on the compass system, and I don't want to spend 2 hours going all over the indicators. But folks that are interested in doing intraday trading, I just want you to understand that you can do that in the room based on the compass system, because I talk about this all day long in there. All right, and again, I'm there in the room from about 9:15 to 4 o'clock every day, so we go over a lot of it. All right, so these are some more of the trades, just so you can see that. But you'll see the same thing here over and over again. You'll see the VWAP, you see the stock price to break it, you see how the current time frame momentum is blue. Enter the trade there, get out of the trade there. So that's how the SPY super system trade works. This is one we took on the IWM. You can see it was bullish most of the day, but what you're looking for is you're looking for a break of a resistance level or a support level. This was the 15 EMA right here. The VWAP was way down here. 15 EMA is another one. This is where you buy it on this pop out of the box. It's already green. You stay in it right here. You get out when the momentum stops. All right. So this is the SPY. Here's the SPY to the short side. Again, pop out of the box symbol to the downside. It's breaking below the VWAP. See the pink line. Current time frame momentum is red. It's bearish. This institutions are selling. I'm getting in here. And again, I understand that this can be very, 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 very confusing. I understand that. But again, for folks who want to intraday trade indexes, this is what you can do. What does the H mean on top? The H. The H. I don't know. Don't know what H is. All right, so anyway, that's the SPY to the short side. On the E line of the New York Stock Exchange. I'll have to look some more. I don't know. I'm not sure what that is. Second line confirming from the top. Open, high, low, close. H equals 22. Oh, you're talking about the high probably? I'll have to think about that. I'm not sure what you mean. 222. Here. Yeah, the only thing I can think of it to me is what the high was for the day, but on that. All right, I'm going to keep moving here. Again, this is another. I just want you to see these SPY setups. There's one there. You see the 15 EMA. You see the pop out of the box. See how we're red here. Boom, boom, boom. You can buy it. All right. And again, there's another one here. You see it's green already. Notice how it's green already here. It's already bullish, but you notice we're below the VWAP. I cannot buy it below the VWAP. As soon as it gets above the VWAP, I can get in right here. This is where I would take the trade here, and then I would get out right here as it flattens out. Stays green the whole way. All right, so those are the SPY super system setups I just wanted to go over and show you how you can trade that for anybody who's interested in doing that. Again, we talk about this in the room all day long. We point out the trades when they occur. I've got a lot of people doing that now, especially on days when we're just sitting and waiting for the market to do something. You know, you want to do some trades. If you can find a good SPY super system trade, good way to supplement the amount of money that you're going to make that day, or at least reduce the amount of loss. In the line where the symbol is open, high, low, close. Let me look here. Oh, I see what you're saying up here. Open 545, 545 here. Open, high, low, close. That's what that is. I mean, this is for that 5-minute period right there that it does that. I don't pay attention to that, to be honest with you. All right, so this is some trades. So this is the trades that we take in the room. These are trades that we take in the room. This is again, this is not SPY super system. This is when we take trades for credit spreads, debit spreads, straight calls, straight puts. This is some we've done recently. This was Lulu. Again, this is a daily chart. I'm taking this off a daily chart right here. And what I'm looking for, this was on earnings on Lulu. I'm looking for the market to the, I'm looking at the multi-time frame momentum right here, current time frame momentum. I'm looking to be bearish, which they are. But I don't want to get in. This was off earnings. I didn't want to get in until we had some compression break. And this right here is moving sideways. This is where I consider this compression break. It's broke down right here. Notice everything was, this went from blue to yellow. This was bearish, bearish, bearish. We bought it here. And this was a debit spread we took overnight. And we made, got in for $1.92 out for $3. So 56% profit on the debit spread on Lulu. Workday right here. This was a 5-day trade. This is a daily chart. Notice we got blue here, blue here. And notice it went yellow here, so I had to be very cautious. But the compass system keeps me in the trade because I'm looking at the current time frame momentum, and I'm also looking at the price action. And this shaded area, by the way, is what's called the dynamic compression zone that the compass system puts in. Okay. Somebody's asking me something here. Okay, this is a daily chart. This is a 5-minute chart. This is a 5-minute chart. These are times, and this is a daily chart. These are dates. All right. So workday. That was a nice 5-day trade for 30%. Again, we stayed with this. It was green. We get a little variation in the multi-time frame momentum, but the current time frame when we get in was all green and blue. GCT right here. This is another day trade. A daily chart. This was a breakout here coming out of this shaded area. That's a dynamic compression zone. You talk about Lulu? Let me see. Yeah, it's a daily chart, Lulu. This was a daily chart right here. This was the earnings right here. See it gapped down, but we took this when we get into this. We took it overnight here. Took it overnight as a debit spread, and we get out the next day as it broke down. All right, I want to get through this because I know I'm tying everybody up, and I don't want to kill your whole day. This was a MDT 25% profit. I'm just kind of showing you the setups that we get from the Compass system. And this is when I talked about the criteria that we use to find them. These are the high probability trade setups. There's a daily chart right here, coming off the 15 on the daily with a pop out of the box symbol, and our break out of compression. We take it here and we get out right there. All right. So these are daily trades. Everything's green, everything's bullish. Take it right here. VKTX, same thing, daily chart. And we get some 5-minute charts I'll get into. This was a nice one on McDonald's, an overnight trade. In for the 8:30, out for 11:30. We got right here as it broke dynamic compression. Everything's green. You can see the institutions are buying here. Absolutely. And we've been in here, we got out the next day, 37% gain overnight. Amazon, this is a 5-minute chart. This was we trading intraday. And you see this pop out of the box symbol here, but you notice that this is yellow. Goes to green. I take it right here on this pop out of the box as it broke above the 15 EMA. That's the support resistance level, and we took 32% profit in 45 minutes on that little run right there on Amazon. PNPH 20% in an hour. Again, you can see I'm looking for a compression. I'm looking for a break below the I'm below the VWAP, but below the 15 EMA. Get in right here. We were in this for 1 hour for 20%. And again, everything's red. We can see the institutions are selling the heck out of this thing. The VWAP, Zia, if you're looking at the VWAP, I don't use the VWAP, even though it shows up on the daily chart. I don't use the VWAP on the daily chart. I only use it on the 5-minute chart. The institutions do not use the VWAP on the daily. They use the VWAP on the 5-minute chart and the 3-minute chart if they're doing that. But the low time frames. Verizon, this was a 50% profit in an hour on this. I remember this one specifically because Verizon options are very cheap generally. They have very tight spreads. We paid 45 cents, $45 a contract for the next week's options expiration. That was slightly in the money, and we get in for 450 for 10 contracts, and we get out for 670 for those 10 contracts in 1 hour. Right down here, nice move on Verizon. And again, this was a SPY super system setup that we had. Okay, here's everything's bearish. See the breaking below the 15 with a pop out of the box symbol. This is telling us we get a compression break. That's what we took. And again, this is a SPY super system, and you're not going to be in it too long. You're in here. This was 4 or 5 candles. This was actually a pretty long one, but typically you don't even go that long. But the setup itself, if you take a SPY super system setup when the setup is available, the win rates are extremely high on these things, and you're getting in right at a support or resistance level. So your losses are going to be fairly small because if it doesn't continue, if I get into here and it broke above the 15, I'm out. Okay. All right. This was a Tesla. This was just to show that we can actually use this for overnight trades. We took this right at the end of the day where we had a pop out of the box symbol to the downside. Everything was red or yellow, so the institutions were selling it. So we took it overnight, and we got a pretty lucky break. It dropped from 120 to 112, and we get out, and the puts, of course, exploded on that. We made a lot of money on that. But again, this is a great trade, and you can see we're following the indicators to do it. But you're not going to always get those kind of big drops like that. All right, so that kind of covers it. I'm just going to go over these are the strategies we use. Again, we spent a lot of time on the SPY super system. I don't know that this is the first time I'm actually spending a lot of time on the SPY super system. I think it's great, but it's not for everybody. But I know there was some folks in here that are interested in being in the room and maybe being in and out, and being able to take trades when they're in there. And so that's why I'm kind of focusing on that. So again, straight calls and puts, debit spreads, time spreads, which is calendar spreads over earnings, weekly ATM, which is a way to capture premium, and credit spreads, another way to capture premium, plus the SPY super system. This is basically what all the stuff we do is, and they're all high probability trade setups. All right, so again, we got some specials for you here. Let me just look at something. I want to make sure that, yeah, they're in the chat box. There's links to the specials here. But basically, the alert service is for a quarter, it's $4.98, and you saw what the profits were, so you know if you think it's worth your while. $4.98 for the alert service, $14.96 for an annual. That's for 12 months, and then if you want to be a lifetime member, $24.96, pretty cheap. But again, that's going to come with, if you get the alert service, you're going to get a month in my training room, which we'll be talking about the SPY Super System setup. We have a Discord room where we have 2 other professional traders that you get access to. Obviously, you get the alert service. And then you're going to get, I have about 25 videos, 26 videos on all the indicators, all the strategies we use, everything we talked about here, plus a lot more. That comes with that, and that's for the alert service. If you're interested in the room, in the trading room itself, the live trading room, that also comes with the Discord instant messaging. And the Discord, by the way, is where all the trades that I post in the room, I also post get posted in the Discord room, as well as going, when the alert squad, it gets posted in the Discord room as well. So the room itself, it's $11.98 for a year. And monthly, you can try it for $148. I don't like monthlies because it's too quick a lot of times. You don't have a chance to really get familiar with the strategies that we use and all of the criteria. But that's if you want to do that, that's what it is. And the full year $11.98 for the room. All right, and the last thing is if you want the Compass system itself, which is a software that goes on, in my case, Thinkorswim. It also goes on Ninja. It's again, that software goes on your Compass system, goes on your Thinkorswim platform, but you do not have to trade off of Thinkorswim. You can trade off of anything, but you can buy the software for a year for $12.49. You get exactly the same setup that you saw in my room, on my screen, and you can get it for $12.49 or quarterly for $5.98. Just use this save 500 here for $5.98 for a quarter, $12.49 for a year. And again, that comes with a 1 month of the trading room, comes with the Discord, comes with the videos. You get all of those, and it also comes with all the scanners I've got. I've got about 6 scanners that we use, Thinkorswim scanners that run all day long in there. I'll show you quickly what they look like so you can see. I have scanners. This was a cascading up scan. This is what's called this is looking for pop out of the boxes, pops out of compression. This is new yearly highs, and I can change these to anything I want. But these are up and running all day long. And with this scanner, if I just click on the stock, it's going to give me the chart. So I can just click on whatever I want to see, and it's going to give me the chart with all the Compass indicators on it. All right. So that's what the Compass system is, and that's how it works. So anyway, again, we got links to these in the chat box. Anybody who's interested in getting into any of these, or if you have any questions, you can call Rory at 786-732-4656. Again, this will all be on the replay that you get. And again, I really appreciate you being in the room today. Thanks for all the great questions. I appreciate that. I know some folks were confused about some of the things we talked about, but again, some of the stuff is fairly complex. Trading isn't easy, but I've tried to break it down to make it as easy as possible. Again, all we're looking at is we're looking at some indicators here that are screaming at us when the institutions are selling. And you're looking at these indicators here, you get the key ones: VWAP, 15 EMA, it's a pop out of the box symbols. That's what you've got. I mean, that's what you trade off of. You're just looking for those setups, and they will generate some money for you. I mean, these things have a really high win rate. So I appreciate you coming here. I appreciate you taking a Saturday to spend some time with me. I hope to look to see some folks. Kathy, going to talk to us Monday. Great, happy to hear that. Thank you so much. And again, appreciate everybody being here. And if you like the discussion on the SPY Super System, give me a yes in the question box so I can see how many people are interested in that. Again, it's very specific for very quick trades, but it's a beautiful system for trading when the market's really choppy or there's just nothing else you can trade at the time. Yeah, great, Breeze, I appreciate it. Thanks so much. And again, look forward to seeing some folks in the alert service. Again, remember, the alert service will not produce the the SPY Super System, you can't do it on alerts. It's way too quick. I just call them out when I see them in there, and you'll be able to see them yourself as well. All right, everybody, have a great weekend. Enjoy yourself. And again, call Rory if you're interested, or click on the links in the chat box, which will get you to the sales. In the alert service, $4.98 for a quarter, $14.96 for the year, and the live trading room, $11.98, and for a year, $148 to try it for a month. And of course, the Compass system. If you're interested in the Compass system, I love this thing. When I found this, I increased my profitability by a lot by knowing when the institutions were in. I was trying to do that with looking at volume and looking at price moves. This gave me all that information that I didn't have before, so I know when the institutions are in there. All right, so listen, everybody, thanks so much. I appreciate it. Again, come into the room if you want to talk about the SPY Super System. You get into the room, we talk about it every day, and I think you're going to find that very interesting if you like to trade like that. All right, have a great afternoon, everybody. We'll see some folks in the alert service and in the room on Monday morning. Have a great weekend.